Hey everyone, welcome to this week's stock and macro update. So this week I'm going to go over a quick review of the past 2 weeks, how the disruptors performed versus the overall market, look at the top gainers and losers for that period as well. And then I want to get into 4 earnings reports for the disruptors that happened over the past few weeks. It's going to be first Lemonade, and then Plug Power, and then Trade Desk, and then Desktop Metals. So let me just start off real quick with the performance update here. So the disruptors index was down 6.2% over the past 2 weeks. Saw a lot of money coming into kind of safe haven stocks, and growth was definitely less popular over the past couple weeks. So the S&P 500 was about flat, up just 0.2%. Nasdaq down 0.96%. Russell 2000 down 1.61%, and ARKK, which is kind of the growth index, was down 10.07% over the past 2 weeks. The top 3 performers in the disruptors index were Guardant Health, up 5.91%, Enphase Energy up 4.79%, and Proto Labs, which was up 4.77%. And the bottom 3 performers were Livent Corp, which is a lithium stock, down 18.25%. Teladoc Health down 17.99%, and Energy Fuels, which is a uranium play, down 15.69%. So again, you can see by the distinction there between the indices and growth, it was kind of a rush to safe haven stocks over the past couple weeks. So things like consumer staples, utilities, things like that were bid up, and it looks like there's starting to be some profit taking in those areas as well, and growth was kind of sold off. So it was definitely a risk off type of environment the past couple weeks. Commodities were also down, so that was kind of surprising because the dollar has come down as well. Usually when the dollar is weak, it actually pumps up commodity prices, but we saw Energy Fuels and Livent, as well as some of the other commodity related stocks, down the most over the past couple weeks. So I don't really expect that trend to continue. People are probably going to step in and buy the dip on these stocks, especially if the dollar remains weak. So getting to the earnings reports, Lemonade first, their sales were up 107% over the past year, which was definitely a very good sign. It was way above expectations, and they also raised their 2022 full year revenue guidance well above where analysts were expecting. They're expanding like crazy right now. So they are a AI powered insurance company that started off with home insurance, trying to disrupt a major, huge insurance market. Obviously not easy to do, but they are definitely the forerunners in that. They're now expanding into auto insurance by their purchase of Metromile, and they're also getting into pet insurance with their partnership with Chewy, which gives them access to 20 million potential customers for that. And pet insurance is a really quickly growing kind of insurance where, I think only 2.1% of total pet expenses are pet insurance, and that's growing pretty fast. So I think that they're doing the right thing here, and that's going to help their business going forward. And they're also expanding internationally. So they are starting to offer their services in the UK, which is the biggest insurance market in Europe. So definitely a good quarter, good results for Lemonade here. Plug Power, sales up 31% year over year, which was a lot less than expected actually. But it looks like a lot of their sales that they expected to make in Q3 got pushed back into Q4 and Q1 of next year. Their backlog was up 45% just over the past quarter. So clearly there's a lot in the works here. It's not like all these sales didn't come to fruition. It's just that they got pushed back a little bit. So in the fourth quarter, they're expecting $341 million worth of sales, which is more than Q2 and Q3 combined. So again, their sales came in below estimates in Q3, kind of disappointing in the short term, but it looks like those are going to just be pushed back a little bit, and their business is still very strong. Financially, they have $2.7 billion worth of cash still, and $547.1 million worth of debt, and only $1.64 billion worth of total liabilities. So their cash covers all of their liabilities plus an extra $1 billion plus dollars. That's obviously really important when you are a relatively young company. I wouldn't say they're exactly young, but in terms of scaling their business, they're very, very young, and they have to use a lot of cash to do that right now. So their cash burn is pretty high, and it's important for them to have all that cash versus their liabilities so that they can sustain this. And it's not going to be much longer before they are cash flow positive, as they said during their earnings call. I believe they are aiming to do that by the end of 2024. And next year, it's going to get a big boost because they're going to be producing a lot more of their own hydrogen fuel. So that's one of their biggest expenses right now, is outsourcing their hydrogen production. Right now, they only produce about 20% of their own hydrogen, and they're planning on expanding that quite a bit, at least by a factor of 3 within the first half of next year. So when they have to outsource their hydrogen, it's correlated to the cost of natural gas because they have to pay for transportation and production and things like that. When they produce their own hydrogen, it's that correlation to natural gas is going to go away, which is very important because natural gas is up a ton over the past year or two. So getting away from having to outsource that production is expected to lower their hydrogen costs by about 2/3. So that's going to give them a lot better looking margins and also reduce their cash burn by quite a bit. The Trade Desk, their sales were up 31% year over year, which is really good considering that a lot of, advertising related companies, tech companies, were seeing really bad results of ad revenue. So the Trade Desk basically runs a platform for companies to buy ads from in a very unique way. I won't get into it a lot here. There's a lot more detail in the Substack, so make sure you check that out. But they have a ton of huge customers. Over 80% of the largest retailers in the US are partnered with Trade Desk. And as companies look to cut costs, they're going to look for a service like Trade Desk, and it's going to obviously benefit them because they're going to get a lot of attention here. The reason for that is companies are going to look to be a lot more precise with their ads. They want to make sure that their ads are being shown to the people who are actually going to act on them and most likely will buy the products being advertised. Whereas traditionally advertising has just been, putting an ad out on TV in a selected time slot for everybody to see, which is not very effective. You want it to be more targeted, and that's exactly what the Trade Desk helps companies to do. Also, the fact that connected TV, which is mostly things like streaming services like Netflix, Hulu, Disney Plus, are going with more and more advertisements. So Netflix obviously announced that they are going to have a cheaper subscription option where they're going to have ads. And all of these companies, from what I'm seeing, are going to use the Trade Desk for their advertising platforms. And that's going to be a huge boost to their revenue as well. And actually, one thing that their CEO said during the call, which stuck out to me, was that eventually it's going to be to a point where the ads are so precise and so good that Netflix and these other streaming services are going to be able to offer an ad-based subscription for free. So they're not going to need the $10 a month or whatever it's going to be from subscribers. They're going to be able to make so much from their ads that it's not going to, they're not going to need to even charge for that subscription, which is really good, and it's going to help. It's kind of a mutual benefit situation where it's going to help Trade Desk because it's going to onboard more customers to them, but it's also going to help these streaming services because with a free subscription where you just have to watch ads, it's probably going to be a lot more attractive to a lot of people, especially if they're advertising things that are relevant to you. So lastly, Desktop Metals, one of our 3D printing plays. Sales were up 85% year over year. Definitely impressive, but still a lot lower than what was expected by analysts. So it's kind of a similar situation to Plug Power, where a lot of the orders were getting pushed back to Q4 or Q1. Management from Desktop Metals said that this is largely due to management from their customers being more hesitant to make big purchases right now given the macro environment. So demand is kind of falling a little bit for their printers and services. But overall, with 3D printing, I mean, it's just such a breakthrough technology and has so many benefits to offer to these customers where they're able to, scale their manufacturing for a cheaper price, that I don't see the demand really going anywhere over the mid to long term. I think that the sales that were missed in Q3 are going to be made up for down the line. Their backlog, like Plug Power, is also very, very strong. So again, it's not that the sales aren't being made, it's just that they're being delayed by 1 or 2 quarters. Obviously, we'll get more details on that in the next quarterly report as well. But another big thing that they announced was a partnership with Align Technology, which is one of the biggest names in dental, which is actually one of the most important kind of markets for 3D printing right now. So overall, I think the total market for dentistry related products is around $30 billion. And the CEO on the earnings call said that 3D printing is expected to basically take all of that share by the end of the decade. And Desktop Metals currently makes the biggest and best dental 3D printers out there. So with this partnership, they are offering through Align Technologies, and really Align Technology is offering kind of a subscription service to dentists around the country of basically made to order kind of supplies for their practices, and those are all going to be made by Desktop Metals. So it should be a pretty good recurring revenue stream for them. Obviously, dental supplies are always in demand, and yeah, it should be a huge boost to them going forward. Obviously, we'll get more details on that going forward, but that is all for this week. So thank you everybody for watching. I will see you on Friday for our crypto update.